167 years. That is how long Credit Suisse existed before it died in a single weekend in March of 2023. It was not bankrupt. On paper, it met every capital rule the regulators required, and it still did not survive to Monday. This is the anatomy of a bank killed by its own depositors, not its balance sheet. The money did not vanish in a single bad trade. It walked out the door, more than 100 billion Swiss francs of it in one quarter, and it never came back. Credit Suisse was a globally systemic bank, an institution regulators had spent 15 years fortifying after the crash of 2008. Those defenses were engineered to stop a slow bank run. What arrived instead was a fast one. To understand the death, start with the wounds. In March of 2021, the family office Archegos collapsed. Credit Suisse lost roughly $5.5 billion. Its exposure had exceeded $20 billion, more than half the bank's capital at the time. That same month, the supply chain finance firm Greensill Capital failed. Credit Suisse froze about $10 billion of client funds it had marketed as low risk. Clients' money, frozen, inside products the bank had called safe. These were not isolated. A corporate espionage scandal cost one chief executive his job. There was a bribery conviction over Mozambican bonds, a criminal money laundering conviction inside Switzerland, and years of legal provisions. The cumulative message to every depositor and counterparty was simple: this bank cannot control its own risk. The first tremor came on the 1st of October, 2022. An Australian journalist posted that a major investment bank was on the brink. He never named it. The internet named it for him, and the name it chose was Credit Suisse. The post was an accelerant, not the fire. In the fourth quarter of 2022, clients pulled a net 110.5 billion Swiss francs. Around two-thirds of it left in October alone, and roughly 60% was deposits, the cheapest and stickiest funding a bank has. Deposits are the denominator of a bank's liquidity math. When they flee, the bank must sell its liquid assets to honor the withdrawals and replace them with expensive wholesale funding, at the exact moment its own credit is most in doubt. Credit Suisse survived October. It never won the deposits back. By February, the full-year loss came in at about 7.3 billion francs. Then, on the 14th of March, Credit Suisse disclosed material weaknesses in its financial reporting for the prior 2 years. 4 days earlier, Silicon Valley Bank had failed. The market was already hunting the next weak, deposit-funded institution, and here was the obvious global candidate telling the world it could not fully trust its own numbers. On the 15th of March, the chairman of the Saudi National Bank, Credit Suisse's largest shareholder, was asked on live television whether he would put in more capital. The answer is absolutely not. His reason was narrow and technical. Crossing 10% ownership would trigger regulation he did not want. The market did not hear the technicality. It heard that the last private backstop was gone. Credit Suisse shares closed down about 24% that day at a record low. This is the mechanism at the center of the autopsy, a reflexive loop. Falling equity pushes the cost of insuring the bank's debt higher. Counterparties pull their balances and close their trades to cut exposure. The bank burns its liquid buffer to meet them. The buffer visibly shrinks, and the next counterparty runs first, to avoid being last. The tell was in the credit market. The cost to insure against a default within 1 year rose above the cost to insure against a default within 5. Traders were no longer pricing a distant risk. They were pricing an imminent one. The Swiss central bank stepped in, offering a credit line of up to 50 billion francs. This is the decisive forensic fact. A fully available 50 billion franc lifeline did not stop the run. When a central bank backstop fails to restore confidence, the question has changed. Depositors are no longer asking whether the bank can pay them today. They are asking whether it will exist next week. So the state stopped trying to save it and started managing who would lose. Over the weekend of the 19th of March, Swiss authorities forced UBS to buy Credit Suisse for 3 billion francs, about 76 centimes a share, against a close of 1 franc and 86 the Friday before. Emergency law was invoked to deny shareholders of both banks any vote. The 3 billion franc price tag was theater. Behind it stood more than 100 billion francs of central bank liquidity, and a government loss guarantee of up to 9 billion. In total, the state and central bank stood behind roughly 260 billion francs, about a third of the entire Swiss economy. Then came the piece that broke a global market. Credit Suisse had issued additional Tier 1 bonds, perpetual instruments that pay a rich coupon in exchange for one condition. If the bank hits what the contract calls a viability event, they can be written down to zero to keep it alive. The regulator pulled that trigger. About 16 billion francs, roughly $17 billion of these bonds were written to zero, the largest such loss in history. And here is the inversion. The bondholders got nothing, while shareholders, who are supposed to lose first, received 3 billion francs. The capital hierarchy ran backwards. That inversion repriced an entire asset class. Investors worldwide had assumed these bonds always outranked equity. Overnight they learned that priority was a matter of contract and jurisdiction, not a law of nature. European regulators rushed out statements promising that in their systems equity would still absorb losses first, an emergency effort to stop the panic from spreading. The Saudi chairman who said absolutely not resigned 12 days later, but the honest verdict is that he did not kill the bank. His words were a trigger on a weapon that a decade of self-inflicted wounds had already loaded and cocked. UBS absorbed its rival and booked an accounting gain that produced roughly $29 billion of quarterly profit, the largest in banking history at the time. Yet stripped of that one-time gain, its underlying profit was near $1 billion. The windfall was an artifact of buying a franchise for a fraction of its book value. The story is not closed. In 2025, a Swiss court ruled the bond write-down unlawful, holding that the viability trigger was never actually met. The ruling is under appeal, and the bonds remain at zero. A parliamentary inquiry placed the blame first on Credit Suisse's own management over many years. That is the lesson of the autopsy. Credit Suisse had capital, it had a central bank line. What it did not have was trust, and in a modern bank-run, trust leaves at the speed of a message, faster than any balance sheet can respond. Solvency is measured in quarters. Confidence is measured in hours. This is capital autopsy.